challenges as well as the challenges, and we'll talk about the next steps in the life of our organization. A few rules of engagement. So throughout this session, if you have questions for the speakers, use the Q&A button as part of the Zoom feature. You have that possibility to ask questions directly to our guest. And Lisa will moderate your questions at the end of their presentation. So there will be time, we'll allocate time at the end to answer any questions you may have. The election of the FACC directors will take place immediately after through a poll sessions. And the presentation in this recording will be made available to you on our website after the event. So with that said, I would like to welcome Jacob Manoukian, Rob Tanner from JP Morgan. So thank you very much for participating into our event today. I briefly introduced the topic, but I'm sure you have lots to say about it. The floor is yours. Thank you. And please start introducing yourself.
Well, thank you, Cedric, and thank you to the French American Chamber of Commerce for welcoming us to your 2021 annual meeting. Pleasure to be here. My name is Rob Tanner, Head of Investments and Advice for the state of Michigan for JP Morgan's private bank. As you can tell already, I'm not a native of Detroit. I actually started my career in foreign exchange at Bank One in London back in 2000. Just after the introduction of the euro, and as a new analyst, I had to memorize conversion rates for currencies like the French franc. Please don't test me on that because I've long since forgotten what that was, but I moved to the States in 2002, thought I'd be here for a few years as an expat, but fortunately met my wife in Chicago, who is native to Southeast Michigan. And together with our 3 young boys, we moved to Birmingham about 5 years ago. And my role here at the private bank is essentially working with our wealthy families that have large, potentially complex estates and helping them navigate financial markets, not just here in the US, but globally. And to do so, I rely on tremendous resources that we have at our disposal here at JP Morgan, and I'm thrilled to welcome one such amazing resource, which is our friend Jacob Manoukian, our US Head of Cross-Asset Strategy. So Jake, I'll turn it over to you quickly, just for a quick introduction from yourself.
Yeah, thank you, and thanks for having us. It's our pleasure to be speaking at this event. As Rob mentioned, I'm the U.S. Head of Cross-Asset Strategy, and really what that means is just helping our clients contextualize what is going on in markets, what's going on in the economy, and putting that into the context of their goals and their portfolios and their investments. My mantra today and every day is to simplify the complex. Markets, economies can be very complex topics, and there's a lot of headlines and a lot of noise that goes on, and really what I try to do is to cut through that noise and try to tell people what matters and what we're looking at to try to sense what is likely to happen in the future and what that means for our clients and their portfolios and their goals.
So Jake, before we dive into where things stand, I thought I'd just take a step back and frame the discussion around where we were at the start of the year, which formed the basis for our 2021 outlook. And that was one of optimism around the fact that the global economy was healing from what was an incredibly tumultuous 2020. And there were 5 key forces that we felt would drive that economic recovery. Obviously, the virus itself, towards the end of last year, there was a lot of positive developments around vaccines, not just here in the US, but across the globe. And the pace at which those vaccines could be rolled out through the start of 2021 would help determine how quickly things would get back to normal. And it was obviously going to take some time, and I think we've seen that, and I'll let you get into this chart in a moment. But to bridge the gap between a state where we were in full lockdown over the holidays to one where we could go out and meet would require some policy support or continued policy support from central banks and governments around the world. On top of that, the I word. I'm sure inflation is going to crop up a lot in this discussion. I'm sure a lot of the people joining this call have a lot of questions about that. Certainly seems to be a lot more topical now with recent CPI releases than it might have been at the turn of the year. But essentially our view, I think, has stayed pretty consistent that inflation, despite some near-term spikes, is going to stay relatively well contained and allow the Fed to maintain interest rates or policy rates at accommodative levels, which is a challenge for our clients who are invested in fixed income and relying on coupons from bonds. But it means that they have been pushed to take a bit more risk in equities, and equity valuations and whether earnings would come out to grow into the multiples that we were paying on equities at the start of the year was one of the other key forces. And the last of the 5 forces was around the strength of the US dollar, supported largely through safe haven flows, and whether the dollar would weaken and allow certainly some places like emerging markets to begin to thrive as we go through this global recovery. So I'll turn it over to you here, Jake, to give us an overview of how those forces have evolved over the first half of the year, and what are the key questions that or concerns that you're going to answer for us as we look ahead through the next 6 months and on.
Sure. Yeah, thanks. I think that's a really, great overview of where we were at, coming into this year. And I'll kind of focus on what surprised us in terms of these 5 forces. In the US and the UK and Israel, I think the vaccine rollout was probably smoother than we expected and went a little bit faster than we expected. It has been more effective than we expected. Mid-April, I think, was the official date when all US adults were eligible to be vaccinated, and in many states, the restrictions had been rolled back before that. So, with the vaccine announcement in November of 2020, obviously was a massive positive development, but there were still a lot of outstanding questions about rollout, supply, capacity, et cetera. And, for the most part, we're at the point in the US where it's all about convincing those who haven't been vaccinated yet to get vaccinated. But we're already at a level where, there's enough, the pathways through which the virus can spread have been diminished to such an extent, either between prior infection or vaccination, that there's not really a lot of places where the virus can go and kind of infect a new susceptible person. So that's great news. Globally, the picture is very different, obviously. Europe's vaccination effort got off to a really rough start with the controversy around the AstraZeneca vaccine. But as you can see in the chart, Germany, Spain are both listed there. France is right in between the two. It's picking up the pace, and we just expect European reopening to be a couple of weeks or months behind the United States. In other places, it's going to be a long time, right? In places like South Africa, where vaccine access is very limited. Haiti, I saw a headline yesterday that no people in Haiti have received a COVID vaccine. So it's going to be a long process for the whole world. But for most major economies, we expect to be in kind of a reopened world by the end of the year.
And Jake, despite the issues around us being in lockdown and potentially, like in the UK that I followed closely, obviously, they are planning to open up even more, especially with the start of the delayed Euro 2020 soccer tournament. But despite the various restrictions, and the lack of mobility, shall we say, economies have been thriving, and there's a ton of pent up savings that make us feel good about the road ahead from here.
Yeah, and in the U.S., I'll just start with the U.S. first. The fiscal support that we saw was truly unprecedented, and what was really unprecedented is the direct injection of cash to American households, and it completely changed U.S. household balance sheets for the better. Credit card balances are close to all-time lows, or at least lows back to the history of the start of the data series. So when you think about what was kind of constraining the middle to lower class in terms of income, it was stuff like high debt and low wage growth. And what the stimulus and the fiscal injection did was it completely reversed that picture. And U.S. household balance sheets are the healthiest they've been in 30 years. As you mentioned, the savings rate in both the U.S. and in Europe is higher than it has been at any point since the 1980s. And it's this combination of fiscal support, so direct cash payments to households, and then just the foregone spending on activities that were restricted during COVID. So, and this is funny because early on in the summer of 2020, I was doing a meeting with a client, and they were, how can, I'm just worried because, people are going to take on, because I was talking about the boom in things like RVs and boats, because what everyone did last summer is they bought an RV, they bought a boat, they bought some toy that would keep them occupied outside and safe. And the client said, well, I'm just so worried about, people running up their credit cards to buy this. And I said, do you know how much a trip to Disney is? It could easily cover a really good portion of that RV or that boat. So, it was just kind of that foregone spending that I think was really powerful. But it makes us feel confident just because it's going to be drawn down over a longer period of time, right? It's going to give this kind of, I think about it like, I don't know, I've been riding the Peloton since I've been in lockdown, and like I wasn't really into like cardio, so like doing the longer rides, like the 45-minute hour rides are a little tough, but I got this like Extend mix, which is like super Gatorade, so that I just sip on along the way to give myself a little bit of extra energy. And that excess savings is kind of like that Extend drink that I'll just have like towards the end of my ride. It's just when I'm feeling tired, just get a little boost, a little extra energy, a little extra electrolytes, and that buffer is still very much there. I think that the reason why this chart is important, and we're missing a label here just with the formatting, but the blue line just shows the revision to US GDP estimates that has happened since the beginning of the year. So coming into this year, economists expected US GDP growth to be 4% year on year, which would be the highest in a decade alone. After the delayed blue wave, so after the Georgia runoff elections, and after the additional American Rescue Plan, which was a $2 trillion stimulus bill, and with incorporating the impact of the ultra effective or highly effective vaccines, I should say, economists have revised up their GDP growth forecast to about 6.5%, right? So that huge revision in growth expectations resulted in a move higher in 10-year Treasury bond yields, which started the year well below 100, so around 80 basis points. And now 10-year Treasury yields are trading around 150 basis points or 1.5%. So that's a big move higher, but it's just following this line of GDP growth expectations. Same thing with the stock market. The S&P 500 is up something like 13% year to date. The entirety of that return has been driven by improving earnings expectations, which are obviously following the improving outlook for GDP growth. Now, the orange line is Europe, which is the interesting thing. So economists have revised their full year GDP growth targets for Europe lower. And that's because Europe outright contracted in Q2 while they were still having very onerous coronavirus restrictions, where if you remember in the US, we had a horrible wave over the winter in the US, but there was really no increase of restrictions to note. I mean, I was still in New York, just bundling up to go see my friends at an outdoor bar, right? There was never a reimposition of true lockdown. So the US was able to roll through that. I haven't touched on China yet, but China's in a really interesting place because their virus containment in hindsight was actually extremely successful. You know, after the initial really hard lockdown, their really hard lockdown in kind of February of 2020, they didn't have a virus problem. So the domestic economy in China has been open for the better part of 14 or 15 months. And we expect that they're just returning to kind of trend GDP growth rates. The other thing that's interesting about China is they've actually gained market share in terms of global exports because they were so relatively unaffected by the virus. So it's a really interesting change in perception, especially in contrast with kind of the Trump trade war era that was meant to reduce global reliance on China and to reduce the US trade deficit. A lot of that has unwound just because there's a massive amount of demand of goods from Americans, and China is one of the most efficient producers in the world and one of the only places that's running at close to full capacity because they've been able to contain the virus.
So going back a little bit there, you mentioned the fact that growth expectations have grown in the US, and that's reflected in longer term interest rates having risen, which in turn has helped initially support the US dollar, which went against slightly what we thought might happen to the US dollar at the start of the year. Some of that weakness has returned as rates in the US have stabilized somewhat, but how has that impacted emerging markets, shall we say? And I mean, we're getting ahead into this slide here. Like, do we think the US is set for another period of outperformance, or have valuations and things turned in Europe and China that make us feel good about the rest of the world?
Yeah, I think especially in Europe, we're pretty positive on the earnings outlook there. We're positive on the earnings outlook there, and the region is still trading at it usually trades at a discount to the US for a lot of different reasons. So, sector composition is the main one. But it's trading at a steeper than usual discount to the US, and we think that the earnings expectations there are underestimated. So we're kind of going through this like rolling reopening throughout the world. So like it's happening in the US now, it will happen in Europe soon, and then it'll happen in emerging markets kind of last, and China's already been through it. The other thing that's challenged emerging market assets so far this year has been kind of mega cap Chinese technology companies, which make up something like 20% of the emerging market equity index. So if you think about companies like Alibaba, Baidu, JD.com, Pinduoduo, these are really big companies that are going through a pretty severe bout of regulatory concerns, and they're down something like 30% from their peaks. So when we think about investing in emerging markets, we just have to be cognizant that that's kind of a catch-all term that doesn't quite do a good enough job at describing the specific exposures that we like to have, which right now we're focused on semiconductors, which is a kind of a Korea and Taiwan story, and then energy, which is represented by Russia.
Well, you mentioned semiconductors, which obviously we've had a lot of supply chain disruption there. Cedric, if we could move forward a couple of slides, or actually one more slide here, because I think Jake, you touched on a lot of.
Yes, yeah.
Obviously, supply chain disruptions and base effects have caused quite a considerable spike in inflation, and we've gone from everyone talking about deflation concerns and I think you termed it Japanification of the US economy, to suddenly now talking about inflation spiraling out of control. As I said in my intro, I feel like we still feel like these effects are transitory, but maybe you can touch on some of the short-term impact of those base effects and supply chain disruptions on what we're seeing in inflation.
Right. So just to set the stage on inflation, and I just want to define a couple of things that we're talking about. First of all, is from the perspective of the Federal Reserve. Something that went kind of under the radar to the most of the mainstream people is that the Fed made a subtle change in how they conduct monetary policy in September of 2020. And what they were doing is they were saying, okay, we want maximum employment. So we want to have the most amount of people possible who have a job, but we want inflation of 2%. So a lot of market participants and a lot of people read that as the Fed has a ceiling at 2% for inflation, and they'll raise policy rates or do other things to restrict economic growth if they think that inflation is going to go above 2%. What that resulted in is a kind of effective monetary policy that was a little bit too tight, because they were being a little too restrictive, and they weren't letting the economy really get to its full potential. Just because think back to 2015. If you remember, in 2015, there was a massive EM balance payments crisis. There was basically a kind of micro recession in the energy complex and the commodity complex. There were a lot of issues going on in the world. The labor market wasn't close to maximum employment. Inflation wasn't a threat, but the Federal Reserve started hiking rates anyway, kind of to get ahead of it. And today, the Federal Reserve, if you take them at their word, which we do, they wouldn't even be close to raising rates in the same kind of environment. The idea here is that, you can see this in the chart on the slide, is that the blue bars are common inflation expectations, which is an index that the Fed maintains and the Fed puts together that just creates one single series that compiles a bunch of different measures of inflation expectations from households, from consumers, from the marketplace, et cetera. During the post-global financial crisis period, those common inflation expectations fell from 2.1% to 1.9%. So that might not seem like a lot, but it's a big deal for markets in the economy, that if markets don't believe that we'll even reach the Fed's target. So that's Japanification, that's secular stagnation. That's a world where demand isn't strong, and that's a world where central banks are kind of out of ammunition to engender inflation. The reason why low and negative inflation is bad is just because you get caught in this trap where, if you think the price of the car or the house is not the perfect example, but the cost of the good or the service is going to be lower in 6 months or a year or 2 years than it is now, you have no incentive to buy it, because you're going to maintain your purchasing power. Now, if you do believe that there's at least some inflation, you're incentivized to spend today, just because that your cash is going to erode in terms of its purchasing power. So it's economically positive. The reason that high inflation can be negative is if inflation is too high and your wages aren't keeping up with it, you can lose your standard of living. So you can't purchase the same basket of goods and services that you could have purchased before, or you lose faith in the currency of the government as a store of value and as a means of transaction. And that's when you imagine the pictures of Weimar Germany with people wheelbarrowing around Deutschmarks and to buy the loaf of bread. That's always a psychological issue, is people lose faith in the government or the store of value, and it's a mess. We don't think that's likely at all, just because the Fed is credible, right? The Fed knows how to fight high inflation. It's to raise interest rates. It's to stop quantitative easing. It's to slow the economy down if it's overheating. They can do that well, right? The market has full faith in the Federal Reserve to be able to do that. The harder part and the more likely issue is that what we think is transitory inflation and what the Fed thinks is transitory inflation isn't so transitory. And they have to raise interest rates before the labor market is fully healed. And that wouldn't be consistent with their goals, because they're not reaching their targets, which again is maximum employment. So the most amount of people possible have jobs, while prices are averaging 2% over a cycle. Anyway, just to close the loop on the change, the subtle change in Fed policy, now they're targeting an average of 2% over time with maximum employment. So what that signals is that they're willing to tolerate an overshoot of that 2% long-term target for a time being, because they know that it'll be under 2% when the economy isn't so good. So we think that it's likely that they'll get what they want, which is inflation that averages 2% over time, which they didn't get during the post-global financial crisis period. So that's kind of the high level story around inflation. And I'll let you chime in before we get into some of the factors that are driving inflation right now and why we think it's transitory.
Well, one question, and what I was going to ask you is, you mentioned wage inflation, or the lack of wage inflation being a potential problem. I think, and maybe we can get onto this after you go through the subtle details about inflation right now, but I think there's a a concern, a valid concern out there that there needs to be wage inflation, but at the very lowest level of income to entice workers back because we're already, we're still down about 10 million workers from pre-pandemic levels. And anecdotally, I was in a local Kroger, and the two people behind me were just complaining about the lack of people to either at the manual checkouts or overseeing the self-checkouts. There was no one there. People can't get people back to work because of benefits. So that's probably a question more related to state of the labor market that we can touch on. But do just finish your thought on inflation, because I think there are some other issues to bring up, and particularly here in Detroit, where we have a lot of people linked to the automotive industry, and certainly there's supply chain shortage with chips, and they just are seeing prices go through the roof. So do finish your thought on inflation and what's.
Yeah, absolutely. And the labor market is intrinsically tied with inflation, because one of the big drivers of goods and services inflation is wage inflation. Because as companies have to raise wages to hire more workers, it follows that they raise the prices on their goods and services to maintain their margin, right? So it's our view that there is still slack in the labor market. It's just that the way to say it, slack, is kind of a wonky economic term. There are actual human beings who are unemployed now who could fill a job in theory. They're alive, they're awake, they're ready to do the job. The problem is just matching the right human to the right job at a wage that's at the break-even level. And that's going to take some time to flow through. And what's hindering that process right now is a couple of different things. One of them is augmented unemployment insurance. So your break-even rate to come back to work is higher. Those are going away in a lot of states very soon, and in all states in September. So once that clears, that will be one kind of barrier to this matching process that isn't around anymore. The second is that there are still some people who are concerned about the pandemic. A lot of this labor market data that we have lags. So whenever they do the surveys or whenever they collect the data is in a, by definition at this point, in a worse environment for the pandemic than we are in now. So as kind of COVID related fears recede, and as more and more people hopefully are vaccinated, you'll reduce that barrier. Another smaller barrier is childcare, right? Rob, you're home with your kids way more often than you were probably planning to be over the last year. And that's, that hinders, for a lot of families, that's a big deciding factor in whether and how many hours you can work, and whether you can hold on to a full-time job, or whether you can look for a job if you need to be around to care for your child. So there are some of these, idiosyncratic issues that are kind of delaying that matching process for labor. But we think they will clear up as the economy continues to normalize. On that break-even level, even if like restaurants have to raise their wages to get people off the sidelines, that's still just a one-time hit. And if you don't have that kind of sustained wage pressure, it's not really an issue from an economic perspective. You'll just kind of see like a one-time step function reset. On the good side, the funny thing here is that there are real supply chain issues. And by supply chain issues, I mean that there's a shipping container shortage. The logistics around the shipping containers were a mess. There was a ship that was stuck in the middle of the Suez Canal for a couple of days, so things couldn't get through, right? The Port of Los Angeles doesn't have enough capacity to offload all the ships, so there's like 20 ships outside the Port of Los Angeles waiting to unload goods. Those are supply chain issues, right? Those are real things that are impacting the supply chain and leading to shortages and leading to long delivery times. What is driving prices, though, is the fact that there's not enough supply, right? The world was kind of the way the global supply chain worked was largely on just-in-time systems, and largely designed for a world where demand was kind of just fine, right? Enter the pandemic. You give people a lot of extra disposable income so that they stay at home and they don't spread COVID, and they want to spend money on new goods and services. and especially goods, because the services sector was restricted in many places. So that's a massive new source of demand for RVs, boats, used cars, golf clubs, fishing rods, you name it. People wanted to buy it. Furniture is a huge one. I'm moving into a new apartment in New York City, and we ordered our new furniture in May, and it's not going to get there until August. So like that's just another example of like there is a massive amount of demand in the system right now for supply that just can't be met. So when you think about like how do you fix that from a policy perspective, and how does it make sense to fix that from a policy perspective given the state of the labor market right now? Does it make sense to choke off that demand by raising interest rates? Or does it make sense to say, we're leaving interest rates right here, demand isn't going anywhere, you should build capacity and you should train some workers and hire them to build all of these extra goods that people have demand for? Like the second answer is clearly the better one, and where we think this is heading.
Right, so that brings us nicely on to the final slide, because in an environment where we feel like the Fed isn't under pressure to raise rates and not choke off growth, and also not reduce the value of future earnings, it again points certainly my clients and our investors towards equities. But it does beg this question: how can we continue going higher after a 60+% return from last March's lows? So could you just speak to our outlook here for equities and what the short to medium term might look like?
Yeah, absolutely. I think it's very natural to say, wow, I don't want to get invested at the highs, especially after this huge amount of return, because it seems expensive and I feel like I missed it and I'm not getting a good entry point. I'm not getting a good price. What we did in this chart on the left is we just looked at periods where the S&P 500 gained 50% in a 1-year period. Okay. So there's a lot of dots here around the Great Depression because stock markets were incredibly volatile. They weren't modern by any means. I'm trying to think, I can't remember right now, but there might be one company that's still in the index and it might be General Electric, but that's a story for a different day. Very different world is all I'm saying. It was 100 years ago, right? After World War II, there's only 4 other instances outside of this year where the S&P 500 gained 50% in a year. Okay. 1943, as the tide of World War II was turning. 1983, after Paul Volcker crushed inflation and Ronald Reagan kind of ushered in this era of the global corporation. In 1998, after the Fed lowered interest rates to deal with the long-term capital management crisis and the tech bubble was being inflated. And then in 2010, when the U.S. was recovering from the global financial crisis. So that's it. And April of this year, the S&P 500 was up more than 50% year on year. Okay. What those periods signal to us is that we're at a turning point into a new business cycle. The world was really scary, but now it's getting a lot better. And we could have a pretty long runway here for equity markets, right? When you look at those periods, the only one that you would even question getting invested in is 1998. But I can tell you, if any money manager shorted the stock market in 1998, they wouldn't have made it to the peak of the bubble because they would have gotten fired. So that's when Rob started working, by the way. It was right at the top. So that's the point here, is that stocks seem expensive, like if you look at a price to earnings multiple, but in a sense you're getting what you pay for, because the earnings results that corporates not only in the United States but around the world are posting are really phenomenal, fantastic. Earnings, year-on-year comparisons right now are tough because we're comparing to a year ago when the entire world was shut down, but earnings growth was up 50% year-on-year on 14% revenue growth for the S&P 500, and we expect continued strong earnings. So we don't even have to pencil in any kind of valuation expansion to underwrite a really compelling equity market return, especially when treasury bonds are yielding you less than 1.5% for the next 10 years, right? Because this is all a relative game. You certainly can't be in cash when your inflation adjusted yield is deeply negative. And owning treasury bonds when the biggest risk is either higher inflation or a tighter Fed isn't really compelling either. So I'm willing to kind of side with the equity market here just because of the excess savings, pent up demand, increased capex for increased capacity, the inventory build that has to come will just drive continued revenue and continued earnings growth. So that's why we feel so confident with equities here.
Awesome. Well, Cedric, I'm conscious of time. We're at about the 40-minute mark. I did want to make sure we left room for Q&A while we have Jake with us. So I'll turn it back to you to open that up.
So thank you so much. I think the last slide here is historical index performance. And again, those documents will be available later on our website. Q&A. Lisa, do we have questions from the audience?
Yes, we have two interesting questions from Paul. So first, what are your perspectives on emphasizing Russell 2000 stocks vs S&P 500 stocks?
Yeah, that's a really good question. So the Russell 2000, just for those of you who don't know, are the kind of 2,000 smallest publicly listed stocks in the US, and the S&P 500 is kind of broadly the 500 largest, right? So the first thing to notice is that the S&P 500 is about 10 times the size of the Russell 2000 in terms of market cap. So just in terms of like the landscape of like investing, the S&P 500 is much larger. Is a much larger footprint. The Russell 2000 had a absolutely eye-popping rally from basically when the vaccines were announced until now. The really interesting thing about the Russell 2000 at this point is that it seems to be really more indicative of retail, quote unquote, retail participation and retail enthusiasm than it is about kind of the underlying fundamental like earnings growth of the companies. And what I mean by that is like GameStop and AMC, which are like what you see on the news that CNBC is talking about with kind of the Reddit Wall Street Bets crowd. Those are two of the largest stocks in the index at this point. So when you're investing in the Russell 2000, you just have a much higher exposure to that kind of volatility and that kind of activity than you do in the S&P 500. So if the question is like Russell 2000 versus S&P 500, like for diversification purposes, it makes sense to own, you know, a little bit of Russell 2000 along with your large cap exposure, but you just got to be smart about it because of what's going on with that kind of like quote unquote meme stock. You know, the really honestly fascinating like meme stock environment that's going on right now. Your second question, which is percent would you allocate to non-US equities? So let's just start with the baseline, which is like the MSCI World is the global equity benchmark. It's about 60% US, 40% outside of the US. And I think that's just like a really sensible starting point, just because equities outside the US tend to have different characteristics than equities inside the United States. The equities inside the United States skew towards kind of mega cap technology / like digital economy things that tend to do really well in the secular stagnation world, where interest rates are assumed to be low forever and when growth is scarce, right? Because they're the only things that are growing. There's more exposure to the kind of like what we're most excited about, I'd say right now, which is companies that are levered to kind of cyclical acceleration and growth in the here and now. If there's one thing that's not scarce right now, it's growth, right? So you don't have to pay such a high premium for those like select few superstar US mega cap companies that are growing. And you can get that same growth exposure from more cyclical exposure. So like Europe, for example, European stocks have a much higher exposure to energy, materials, financials, et cetera, which are the sectors that seem pretty compelling right now and really weren't for the last decade. So we're recommending like a pretty balanced stance between US and ex-US for US people. And by balanced, I mean like around the benchmark. Ooh, another one from Paul. Do you mind if I read it or do you want to do it, Lisa?
No, you can go ahead.
Okay. So Paul's final one, value versus growth. This, okay, just for those who might not be as familiar with the investing terminology, growth stocks is just like a bucket of stocks that exhibit the best growth characteristics. So they're kind of the exciting ones that have long-term growth profiles. So think about like Apple is like a great example of like a growth stock. Value stocks are the stocks that seem inexpensive, right? So think about like stocks like energy, for example, is a good one, because and the real difference and why there's a big dispersion in the value versus growth thing is because Apple, you can put a high multiple on their recurring revenues and earnings because they're an awesome company with a fortress balance sheet that's probably never going to default. Everyone has an iPhone that they upgrade every 2 years, and they, you know, there hasn't been a legitimate disruptor or challenger that's going to make me switch from my iPhone, because I don't want to be the person with a green text box in the text chat. I just can't even have text threads with people like that. So there's not a lot of impetus to move away from the iPhone, right? So you can put a pretty high multiple on a company that does that. Energy, on the other hand, oil prices are all over the place. They're super volatile. That's what their revenues are derived from. They usually take on a lot of leverage to build the oil rigs and the oil drills. So they're indebted. They don't have the greatest balance sheets, and they have really volatile cash flows. So you put a lower multiple on their cash flows. What's interesting now, though, is that for the first time in my career, I can say that the valuations on those value stocks are probably out of whack. If you asked me before COVID, I would say, you know, those stocks are cheap for a reason. And they're cheap because the world's moving away from fossil fuels and interest rates are going to stay low forever. But now I think people should just be more balanced between value and growth, especially after in the last decade, again, as I was mentioning before, in the period of kind of like secular stagnation, growth stocks had a massive run of outperformance. And there could be scope for some of that outperformance to close if we do sustain this kind of higher run rate of potential global growth, given all the factors that we talked about before. So thank you for your questions, Paul. Really interesting.
I feel like I feel like we may be running into some compliance issues if we get too single stock focus there. But thank you so much, Jake.
Yeah, I didn't mean Apple as a recommendation, just for the recordings purposes, just as an example.
Yeah, as an example of growth versus value. But do we have any other questions, Lisa?
Yes, we have another one. So material shortages, disruptions in the supply chain will eventually go away, lessening the pressure on inflation. At the same time, tariff barriers and regulation with minimum salary requirements are going to create pressure on inflation. At the beginning, you said that inflation was temporary, but some elements creating inflation are here to stay. What do you think?
So, you know, some elements creating, again, let me just level set with what our view is. You know, we think that the Fed is going to be able to get what it wants, which is inflation that averages 2% over time, which is higher than it was during the last decade. Like, I think those examples of the things that are causing inflation that are here to stay are valid, but so are the things that are causing pressure in the opposite direction. So if you think about globalization of the labor force, it's probably not going to reverse anytime soon. You know, President Trump tried and it didn't really work. If anything, like the direction of travel on tariffs is probably lower and not higher and at least stable. So then you think about the other huge factor in deflationary pressures or disinflationary pressures is technological adoption. And the example here is like, think about the value that a value that the preeminent social media company, just to avoid that issue again, has been able to create without really charging a fee. So like, to go on the app where I see pictures of all my families and friends and get served advertisements, like a lot of people would pay like a monthly fee to go on that service, but they don't pay anything. So like, if anything, we're probably overstating inflation just because like you would expect that gets counted in the basket of goods and services that we're consuming, but it doesn't, because you are the product, right? Like you are what that company is selling to advertisers. So there's a lot of issues like with the counting of inflation, and you can measure the technological impact, which is definitely that you can measure the technological impact. So think about like your TV, right? 10 years ago, you would have bought a worse TV, worse quality for a higher dollar price than you would now, right? So there's equal factors bringing inflation lower. The bottom line is that we just think we're in a higher demand environment where balance sheets are in a better place. Households have room to relever. There's a lot of pent up demand. And that's just going to lead to a stronger economy, which leads to slightly stronger inflation. And a lot of the things on the extremes are going to wash each other out.
Very good. Very good.
Thank you.
Lisa, I think we can stop the Q&A here. All of you in the audience, if you have questions that have not been answered today, feel free to send us an email, info@faccmi.org, and we'll be able to send them to our panelists today. Rob, Jacob, thank you so much. Thank you so much for all your insight, for the valuable outlook that you gave us today relative to the economy, relative to some of the factors that are affecting us in our daily life, whether it is personally or professionally. We learn a lot thanks to you. So Rob, I think that you're local to Michigan, so we'll be able to cross paths again soon. And for all of those of you who want more information about the services by JP Morgan, I think they can reach out to you.
Absolutely. And thank you again for inviting us into the meeting. It's our pleasure. Thank you, Jacob.
Thank you very much. It was our pleasure. Thank you.
Super, thank you. You're more than welcome to stay, but I'm moving on to the next part of our meeting, which is our annual meeting. So I just wanted to recap with all of you here the activities of the Chamber in the last 12 months. So starting with June last year, we had an exclusive interview with the CEO of BorgWarner, Frédéric Lissalde. June, we had an entretien with Guillaume Lacroix, our General Counsel of France in Chicago. July, some of us had the pleasure of meeting with the Ambassador of France to the United States here in Bloomfield Hills. And in August, we had our annual European American networking and wine tasting at Meadowbrook. Unfortunately, not in person, but it was still a fabulous experience visiting the cellar, talking to the curator, and so on and so forth. September, Future of Mobility with our partner Business France, interviewing some startups in the domain of the mobility. Followed in October by our annual meeting, which at the time was focusing on the program Lightweighting and Electrification in the Automotive Industry. October, we had Virtual Health, New Challenge and Opportunities, which was done in common with other FACC chapters in the Midwest, as well as our Beaujolais Nouveau in partnership with the Alliance Française in November. Most recently, Life After COVID, we had a very interesting webinar with various panelists from various industries telling us how they were seeing return to normal, and probably not exactly the normal that we were expecting prior to COVID. Fascinating insight in what those professionals were saying and thinking. And as of this morning, we participated together again with Business France in an interview of startup with hydrogen in mobility. So all of this to tell you that even in the time of the pandemic, the FACC has been providing you with a service of information, service of networking, service tailored, I would say, for a significant part to the automotive industry, but which is also reflecting or reflective of the makeup of our membership and reflective of the companies who are members. So I would like to thank all of you who have been supporting us during that stage. I want to talk about financials. So financials membership is good. We are still maintaining a level above 200 corporate and individual members as of December of last year. Unfortunately, as you would expect, we have not been able to extract value or revenue, as much revenue as before, because of the tailoring of the events to a virtual format. But as a result, we have also been able to tailor our cost structure to the point where we have limited our cost or losses to about $9,000 last year. I just wanted to put in perspective the profit that we made in 2019. So considering the circumstances of last year, I think that we have done pretty well in 2020 as it relates to our financial position. So the FACC is still very much stable and healthy, and we have retooled, we have learned a lot, like many of you, through that period, and we have been able to adapt our communication and medium to the new reality of virtual, and degraded slightly our cash position, but remaining strong. With that said, I would like to introduce to all of you the slate of candidates for the board of directors this year. So most of these people are, I would say, renewing their terms, and they are representative of companies who have been supporting us and supporting the association. I would like to officialize a poll, so let me launch it. And you have to tell me whether you agree with the proposed candidate to be elected for 2-year terms as director of the FACC. So I will leave it, I will give you a couple of minutes, or a few minutes. I think we're almost there. So thank you very much. I think I will take the results as is, sharing the results. So you should see them on your screen, but basically 93% yes, 1 abstain. So I will take it as a yes. And all the individuals shown on the list are being elected for another 2-year term. So thank you. Thank you very much, all. I will conclude this meeting with a quick word about our next event. So I invite all of you to join us, join me, July 22nd, for the resumption of our live event in Meadowbrook Hall with our 10th European American Networking and Wine Tasting. So a quick word about the event. We are going to have fabulous wine. We are going to have very exotic cars on display. I'll just quote a couple of them. We will have a Bugatti Coupe Atlantique. We will have a Bollinger B1 prototype. We will have a Polestar. So we are going to show vehicles that you don't see usually. And that should make it very interesting. I would like to also highlight one of our partners, Navia, during this event. Navia has an automatic shuttle that is going to take our guests from the parking lot automatically into the gate, the main gate of Meadowbrook. So if you have never ridden into an autonomous vehicle, that's one of them. So I invite you to try and experience. The next event, or I'm not sure if it's going to be exactly the one immediately after, but I wanted to identify for you right away the date of our gala. So the main fundraising event of the year, November 5th. I'm glad to announce to you that our honoree guest of honor this year is going to be Mark Stewart, Chief Operating Officer at Stellantis in North America. So Stellantis is going to be honored this year. It makes perfect sense because of the merger between FCA and PSA at the beginning of the year. And we are very honored to have Stellantis and Mark Stewart accepting our invitation on November 5th. So this concludes the event today, our annual meeting. Again, I would like to thank JP Morgan for their participation, their contribution to our organization. And I would like to remind all of you to renew your membership if it's not yet done. We depend on you. Thank you very much, everybody. Looking forward to meeting you on July 22nd or November 5th or at the next possible occasions. Thank you so much. Bye-bye.